Paul, let's talk a little bit about one of the classic nursery rhymes, "Sell in May and go away." What age did you start getting your kids up to speed on this one?
Within the next year or so, I'll have my son privy to these seasonal trading patterns that there's Sell in May, Go Away. There's the Santa Claus rally that we talk about a lot around year end as a focus. What are some of the other ones that I may be
The other one that
forgetting?
people like to talk about is Uptober, where
Yep.
because September tends to be a month for sell-offs, October tends to be rebranded as Uptober. So that's one that is always popular out there. But you got this piece here. It's titled "Sell in May, Don't Get Taken In by Seasonal Trading Patterns," and I think that look, here's the deal. Quite honestly, on any of these pieces, like seasonality is a real thing. Like it's not something that just doesn't exist. But it's also something where you have to remember that seasonality is an average of what we have seen at different points in the year historically. And that doesn't mean that it inherently follows that same path every year. And so I think seasonality can certainly have, some interesting explanations for why certain things happen at certain times of the year. But it's not something that you can inherently base a plan around, and there can certainly be other things going on in the short term in the economy that can override it, which is why it's not something that is in any way, shape, or form reliable. If someone were to be considering trying to make it, the basis of how they are going to invest.
No, the major takeaway I had from this piece, and like you mentioned, the seasonality stuff is fun to talk about, but never should be an investment thesis for anyone out there, just because the unpredictability of market returns. But there was in this CNBC piece a hypothetical growth of $1,000 invested in the S&P 500 in 1970, and this comes from Dimensional Funds. They did this study that if you were to invest $1,000 in the S&P 500 back in 1970 through 2019, that $1,000 would grow to 138,000 bucks, almost $139,000. However, if you had missed the 5 best days of the S&P 500 during that period from 1970 to 2019, your $1,000 would be 90,000 bucks. So almost a differential there of about $50,000 between the 1,000 that grew to 139 for 2019 in 2019, 139K, versus the one where you missed out on the 5 best days. And it just reiterates the point. I think it's helpful, Chuck, to look at these types of things amidst market uncertainty and turmoil, the long-term nature of investments, and also it also reiterates the idea of not trying to time markets, because missing out on significant up days really can hurt your returns over the longer time. So that's the main takeaway that I had of these pieces. It's nice to look at these numbers over a wide period of time when you're sort of in the throw of things, when things are uncertain.
All well and good. Can I tell you why I really dislike the numbers that you just read, actually?
Why?
So here's the thing. So if you miss let's just use that one there. You miss the best 5 days every year for 55 years.
Yep.
Actually, this is through August 2019, so it's really through 49 years.
Mm-hmm.
First question that I have, Paul, what are the odds that if you make changes to your investments, what are the odds that the 245 days that you pick to be out of the market are the worst or are the best 245 days in that 49-year period?
Extremely slim.
So, like, that's not realistic, number one. The other piece is that typically, as we've seen this month, I think April of 2025 is a great example of this. The best 5 days and the worst 5 days of any given year usually occur in pretty close proximity.
Mm-hmm.
It's not an always situation, but it's generally something that we talk about where, look, volatility doesn't usually just move in one direction, it can move in both. And golly gee willikers, we've seen that this month simply because you had one of the worst 2 and 3 day stretches that we've ever seen in the S&P 500 at the beginning of the month, and towards the middle of the month you saw one of the biggest single day upward moves in the S&P in its history as well.
Mm-hmm.
So I guess what I'm getting at is, sure, if someone if we really believe that it's a coin flip from day to day, which I think is where I land, is that look, I have no idea if the market's going to go up, down, or sideways tomorrow. It's a coin flip, and that's by the way what the data shows is basically that from day to day, it's pretty close to a 50-50 chance as to whether or not the stock market is going to be up or down in any given day. It's a slight bias towards up, but it's very small.
Mm.
If one believes that, then why would the data about missing the best 5 days be relevant? Because if someone were to try to trade the market, it's more of a coin flip than anything else. And furthermore, even if it is a coin flip, why would the days they miss specifically be the best ones? You know,
It's not necessarily.
I
It's just I don't take it to the exact extremes of the absolute dollar return. It's more for illustrative purposes for
yes,
the recurring
yep,
theme of like investing over a longer period of time. But yeah, absolutely. Point taken. It would be unbelievable serendipity that this would ever occur for anyone. But we know you've experienced with clients. There are some out there that
yes,
you just couldn't talk of selling out, and the problem with them in general, whether it be 2008 or March 2020, whatever difficult times, is they were slow to get back in, and they missed on not necessarily the best 5 days or anything like that, but missed a significant rally back from what was a very difficult time in the market.
what I can tell you is if you do happen to find the person who always misses the best 5 days in markets, I'm interested in meeting them as a contra signal.